Welcome to the Pocatello Business Podcast, the only Pocatello podcast focused on providing profits for Pocatello people. If you love our town and love small business, you are in the right place. We interview local legends, learn business, and have way too much fun doing it. You're listening to the Pocatello Business Podcast with your friend, host, all-around great guy, and owner of New Clean Commercial Cleaning, Spencer Ward.
So, for example, you on your P&L that you showed revenue, and that's great, but what happens with the companies that are selling different services? For example, I'll use my company, for example. I've got janitorial services that are just going in at night, cleaning nightly, weekly, whatever it is. And then I have floor services, hard floor services, carpet cleaning, stripping and waxing. At what point would you recommend separating revenue out and also separating cost of goods sold out so hey, is this service that I'm providing, is it profitable, or do I just fold it up and subcontract it out?
Great question. Every business, I think, eventually is going to find that they can segment their revenue into more than one revenue source. You have different service offerings on the cleaning end. In my CPA realm, it's tax services, it's audit services, it's business valuation services, and there's labor pools around each of those, and each of them make different kinds of money as well. It's different across the board. And so, like you, being a business owner, I have also been, benefited and challenged by trying to break out an income statement or make an income statement that informs me very, very well of those things. I certainly don't want to be engaged, similar to you. I don't want to be engaged in a line of business or a revenue generating activity that does not provide me a profit margin. I don't want a sandbag in what is otherwise a profitable company, right?
Very good.
And the only way I can diagnose that or determine that is by breaking out my income statement into maybe more minute columns, minute detail. You can do that one of two ways. One is that you can, in each of the lines, in fact, I'm going to go ahead and share my screen again. So a couple ways that we could do that. I'm going to hide this column.
And those that are listening on the podcast, sorry, but you're going to have to go watch this on Facebook so you can actually see it, or on our YouTube channel. So
couple ways you can do it. One is that you can go ahead and add lines here. So I'm going to just use my industry. Hope that's okay. I could say tax revenue here and audit revenue here, right? Okay. And track them differently. And in the cost of goods sold, then also break it out as well. The problem being is that for me to truly analyze the profitability of the business, I'm going to have to almost hop on another Excel spreadsheet and pull out those expenses and say, okay, am I profitable? Another way to do it is that you can say, okay, here's tax, here's audit right here, and pretty much run two income statements.
There you go.
Right next to each other. Say, okay, here's tax and here's my audit one. And as I'm going through and categorizing, saying, okay, does this go in the tax column or the audit column? This is much easier when I shouldn't say it's much easier. It's going to be much easier for the business owner to interpret if it's done this way. QuickBooks it's called class accounting. That's what it's called. It has awesome inputs there. That, if you just toggle class accounting, it will give the opportunity on every revenue and expense to tell which class it goes in. Does it go in the tax class or the audit class? And you'll find that your income statement builds out to be something really pretty. My personal books, this is how I do it. And I'm an accountant, so I'm probably too detail oriented on my own books, right? But my own personal books that I have my tax revenue and then my personal budget as well. Everything is classed out, and makes it nice to look at.
Would you recommend, and this is just me spitballing, so correct me if I'm wrong, when you have another revenue source coming in, not worrying about breaking it out until it exceeds a minimum of 10% of your revenue, or it should be more?
I like 10%. I don't think there's a hard number. I think the first indicator needs to be if the business owner is questioning whether or not it's making them money, that should be the first indicator saying you probably need to analyze it then. if there's any concern that that's a non-profitable aspect of your business, then break it out.
I like it. Perfect. So I think all the answers, all the questions on the P&L that I could think of or other guests have asked have been taken care of. We'll probably have a few questions if you want to talk about the balance sheet now of what we're looking at there. If you want to, do you have a sample that you can share again, or?
I do. So this is going to look a little, I've just tried to simplify this. I didn't want to make this too, it's going to look different than the balance sheet that you're going to see probably in QuickBooks, but the goal of this is just to explain what a balance sheet does.
Sure.
So what we have here, and go ahead and share my screen. You see that okay?
Got it, yep.
Okay, so a balance sheet is made up, I'm going to just color code these, made up of three things, okay? It's made up of assets, liabilities, and equity. The three things that make up a balance sheet, okay? Now, you're going to hear the word, does the balance sheet balance? You will hear that said often, okay? And the reason why they say that is that assets should always equal the sum of liabilities and equity. They should always offset one another, okay? There's perhaps more detailed reasons why that happens, but the long and short of it is that your assets will always equal your liabilities and your equity. And a very healthy business is generally one that has a lot of equity, that does not have a lot of debt. So in the example that you see right here, this prior year column, I have assets of 600, fixed assets, that's just being my accumulated depreciation. Just follow me here on this, but total assets of $500,000. You'll see that liabilities is the offsetting balance to that. In other words, my entire position in my business is informed by debt financing. Is the business healthy? Probably not terribly healthy. It is a business that's entirely funded by liabilities. Now, granted, there is obviously going to be exceptions to every rule here, but ultimately you'll see right here, I've put them all as current liabilities, which means that their liabilities are generally resolved within 30 days. This business right here is probably a little spooky, okay? A healthier business would say, okay, no, I have about 100 in current liabilities, and the remaining portion of my business is an equity, meaning that it's retained earnings, it's investment that I've made into the business. It's really just saying that you have a very strong cash position in the business. It's not informed by having a lot of debt. Does that make sense?
Yeah, that makes sense.
Got it. So again, it's informed by current assets and fixed assets. Your current assets are generally going to be those assets that turn in a short amount of time. So cash on hand or assets that you can easily convert into cash. So your current assets are going to be things like accounts receivable, your inventories, short-term investments, and cash. Your fixed assets are going to be things like property and equipment, improvements that you make to your space, longer-term investments that you're making, accumulated depreciation that you might have on those assets too. So if you're buying property and equipment, let me go ahead and undo a few of these here. So if you're buying property and equipment, let's say a fleet of trucks or something like that for your business, and they've depreciated in value, that's what you're seeing there. Accumulated depreciation is just an accounting function. It is not a representation of true value. It's just something that's governed either by tax law or by generally accepted accounting principles. It's hard to kind of explain in a 20-minute snip here.
No, that's fine.
But that's what you're going to see right there. Other assets can just be other investments that you have as well. But that's generally what you're going to see. Three categories: current assets, fixed assets, other assets, long-term assets, things like that. Liabilities kind of fall in similar form. Your current liabilities are going to be accounts payable, wages that you owe in the short term, income taxes payable. This one's getting probably too complex, but let's just say property taxes payable, just liabilities, things that you owe in the short term. Your long-term liabilities are going to be things like mortgages or long-term debt that you have on equipment. Those are going to be represented in your long-term liabilities section. And then finally, owner's equity. So that's going to be the accumulation of profitability that you've had over the years, plus capital investment that you've made into the business over time. So businesses, when they're starting out, generally have a lot in the way of liabilities, not a lot in the way of owner's equity or this equity section. As time goes on, as the debt is paid down, as the business is profitable, you see those liabilities migrate down to the equity section, and the overall health of the business improve with time.
So do you stand by, you hear it all the time. Everyone always says, oh, when you first start a business, you're not profitable for the first 3 years. That's not always the case, but is that generally the case you're saying?
Yeah, I think that word is generally informed to tell business owners, don't expect to take too much from your business those first 3 years, if anything. I mean, you can still be profitable, but that profitability is going to go towards paying down debt, to handling lines of credit, to handling your payables. Not unusual for the first 3 years of a business owner, particularly those that are just bootstrapping it and just starting out initially, to go through kind of that pain period. Those that buy businesses, let's say you're buying, a dental practice or something like that, can generally forecast saying, okay, yeah, I had to buy this individual out, but there's a stable ongoing cash flow there that I don't have to necessarily build.
Sure.
So
it's
if you're building it, I mean, this balance sheet right here is a great illustration why so many businesses struggle and maybe at times fail. It's just an inability to interpret, here are the assets that you have and the liabilities, and are your liabilities overwhelming the assets that you have?
Perfect. I like it.
So
go ahead.
I was going to say, I love a balance sheet. It's like I said, it's a moment in time snapshot of how healthy a business is. It is not a period of time. It's as of today, what's going on, how healthy is the business today?
Sure.
And again, it's the interpretation of it's always going to be subjective. There's going to be reasons why liabilities are there. There might be great terms that you've established with your long-term debt as well, that make liabilities more tolerable than they may otherwise be in your industry. It's always going to be different, but for me, a balance sheet, I think, tells a good, healthy story.
Perfect. Speaking of liabilities, say a company is growing and it's doing well, but it needs a new piece of equipment or something to continue to do well or be more efficient. When would you tell them to buy instead of rent if they can? When would you tell them to buy said equipment or vehicles they need?
I really like this question because so much of business owners' equipment is purchased right at year end because some CPA told them that they had a tax trouble. Okay. And listen, I'm not an innocent man. Spencer, I've probably told you, can you buy any equipment? I've probably said it myself. Okay. But you're informing a good question people should ask themselves, is that buying a piece of equipment it should always be viewed as an investment. And so it's going to be impossible to perfectly and accurately forecast what the return on investment will be for a piece of equipment. But every piece of equipment should have an inherent return on investment. And if it doesn't, then that should probably in your mind challenge the veracity of the purchase. Your goal at the end of the day as a business owner is to get out of the minutia as much as possible. Do not spend your time doing things that you can pay someone else to do, and spend most of your time innovating, generating revenue, being a visionary for your business. And oftentimes investment into fixed assets are your way of doing that. Your investment into equipment, into people, into whatever it takes. Your goal long-term is to get yourself away from things that you can buy, the resources that you can buy. And so in my mind, when you're evaluating whether or not to buy a piece of equipment, that should be question number one is it freeing up my time to be a visionary for my business? And if it is, then it's probably a wise investment. That informs a good question. Follow-up question is, what about buy versus lease? And the answer is that depends. That depends on the lease terms. That depends on the purchase price. That depends on the piece of equipment as well. Does a piece of equipment have a strong retail value, resale potential? Are there benefits that you gain from owning it? Well, from a tax perspective, certainly there is. You can write off the whole value of it as opposed to just writing up your lease payment. So most CPAs are going to be inclined to tell you, hey, let's buy instead of lease, just because we like writing off big pieces of equipment.
Sure. Okay.
Probably more than jargon on an answer there. Sorry about
that.
No,
I really like that answer. And it brings me to what I think a lot too is that, your business is there to serve you. you're not there to serve your business. And I think that's what happens, especially when companies start out. They think, oh, you know what, I better get this big truck and put my logo all over it, and it's not really making me money, or whatever. It's
Right.
People want the new shiny twinkly things, but you got to ask yourself, is this going to directly influence more income coming into my business? And if you can't honestly answer that yes, don't buy it.
I agree.
Wait until you're established business, you got a little more net profit coming in, and then let the company serve you and buy you something nice that you can use as an owner to travel around to your job sites, whatever. So
Right. Yep. Great advice.
I like it. Well, is there anything I wish I should have asked that I didn't? Go ahead.
You asked great questions. I don't think it's that you missed anything. At the beginning of this, I prioritized these financial statements on their importance. Your income statement is where people, if you don't understand, invest time in understanding your income statement. It will inform good decisions. Balance sheet being probably where you invest your time next. Long term, your gold standard business owner can understand and interpret a cash flow statement. That is a powerful resource, but requires a good understanding of these two statements before you can understand this one. And so let that be your goal as a business owner, to be proficient in interpreting numbers. You do not need to be a CPA or an accountant or get bogged down in the numbers. Just be able to interpret them. That's the important part.
I like that. And before I go to your last question, I'm going to take one more sponsorship timeout, and we'll go from there. So we're sponsored by the Dale's Outdoor Advertising. Man, these guys are quality guys. The Kirkhams have been around forever, and they just run a quality billboard business. If you want some top of mind awareness, which I personally just received a sales call from my billboard because it was a trackable number I used, and I knew as soon as they called that number, it was tracked. I knew that came from that ad because that's only where that number was at. You're going to have some good experiences with these guys. And if you sign up for 3 months, you get your first month for free or free installation. So call Rob at 208-232-6886. Again, 208-232-6886. Ask for Rob and tell him you heard about him on the Pocatello Business Podcast. So, well, Dan, I think we need to keep having these discussions because I'm sure as more and more guests come on and especially watch this episode, they're going to spur other questions in their mind. And we'll use you as our resident guru for this area. So, yeah. And then again, mention that offer, since we're cutting this into 2 parts, mention that offer again if someone mentions the podcast and they call you.
Yeah, if they give me a call, mention the podcast, we'll get them a first research industry report. It's a report that will help them get an industry forecast for their business, help them understand what national growth trends are, what they see as opportunities and risks within your industry as well, and even help you build an income statement that you can compare to industry standards as well. So it's a great tool, and definitely some good weekend reading for any business owner.
I like it. And that's a very helpful tool. So take them up on that, guys. And Dan, if people want to reach out to you and say, hey, obviously from listening to you, you're bright. If I want to make a switch or I need your help specifically, how do they get a hold of you?
Yeah, reach out to me here at Cooper Norman. Phone number here is 208-523-0862, or shoot me an email at dpackard@coopernorman.com. That's DPACKARD @coopernorman.com. Spencer, we're going to be doing a tax planning webinar here for Cooper Norman within about a week and a half. It's going to be good stuff. Man, so much has happened here in 2020, particularly in the realm of taxation. A lot of new legislation. Business owners need to be astute this year and do tax planning. And so we're going to put on a webinar that outlines the 20 things they need to be thinking about. But your listeners are more than welcome to tune in. I'll send you a link if you want to get that out to individuals as well.
Yeah, we'll have to put that on our Facebook page because it'll probably, this episode won't air within a week and a half, I guess. So.
Got it. Yeah, that'd be great. And then, let's have a follow-up podcast where we can talk about some of these things in greater detail.
I like it. Well, I appreciate you being on the show again, bud.
Hey.
Congratulations on spending a couple minutes getting just a little bit smarter, having some fun, and supporting the Pocatello business community. If you are feeling the love, make sure to subscribe, rate, and review on iTunes, Stitcher, or wherever you are.